CFA exams. Anybody done their CFA? Did the exams? What did they teach you in CFA exams to do with an operating lease? Do you remember?
For the financial analysis side, they bring it on balance sheet.
Correct. So if you're doing your CFA as a financial analyst, we would tell you the accountants are stupid. They ignore the operating lease. We would tell you to do a calculation, remember this, to change the assets, to change the liabilities, and to redo the ratios. So if you're an analyst, and you're the person who's going to be reading the financial statements, and that's what we teach you to do, wouldn't it make sense if the preparers did it for you? Wouldn't that be more logical? So if that's what analysts are trained to do, it makes sense to flip it around, because you as the preparers are supposed to do it for them. Because what's interesting is the accountant's perspective is, oh, the standards are becoming too complicated. Some of them are. The analyst perspective is, you guys don't give us what we want. The U.S. did a study a few years ago. This was in 2005. And there was a recent study by the ISB, which was a different number. But in the United States, they said there's about $1 trillion of leases that are off balance sheet because they're an operating lease. And I think when you look at it from an IFRS perspective globally, the number was 3 or 4 trillion. They also did a study more recently, because obviously more companies use IFRS than US GAAP. So most leases are off balance sheet. Most leases don't affect our ratios. And wouldn't it make sense to fix it? So this is a project that was done jointly with the US and the ISB. And they said it makes sense to take leases and put them on balance sheet. So that makes sense, right? So if you take a lease and you put it on balance sheet. Anybody work in telecom sector here? No one in telecom? If you're in the telecom sector, one of your key metrics is EBITDA, earnings before interest, tax, depreciation, amortization. So if you take a lease and you change it from operating to finance, what happens to your income statement? Does it stay the same? Does it get better or worse?
Better.
What gets better? EBITDA gets better, right? Because what happens is you're going to take your operational expenses and reclassify them as depreciation. Your interest changes, right? So what would happen if you change it from an operating lease to a finance lease? You recharacterize the income statement. Now the Americans didn't like that. The Americans said, we don't want to change the characteristics of the income statement. Now, what happens to your assets, net assets? Do they go up, down, or stay the same if you take things to go from an operating lease to a finance lease? Do net assets go up, down, or stay the same? Obviously up. What does net assets mean? Net means assets minus liabilities, right? So why do they go up? They won't change. They go from obviously up to won't change. Okay, you sure they don't change?
On the initial recognition, they would not.
Generally. Would they go up, down, or stay the same? You're a partner, right? Technical partner, right? Up, down, or stay the same? You say down?
Over the time, it would be down, or on the initial recognition.
But generally, you know, when you prepare your accounts for your clients or for your company, would your net assets be the same, go lower, or go up? So what generally happens is your assets, they don't go up, okay? Your assets minus liabilities, usually go down. Why? Because when you take the assets, they go down on a straight line basis, right? So normally assets are depreciated evenly. Correct? Liabilities, we use the effective interest rate method. Your first payment is mostly interest, and your last payment is mostly principal. So what happens is the liability will usually be bigger than the asset because it goes down slower because we allocate more of the payments initially to interest. So the net assets actually go down. Because obviously, even initially, you don't buy all your assets at the same time in a company, right? I mean, that would be a very unusual situation. Even when you adopt the standard, you have tons of old assets. When you bring them on board, so the other impact of this standard is it could change your net assets. So the two things the Americans did not like is the Americans did not want to change net assets, and the Americans did not want to change EBITDA. Does that make sense? So the Americans said, we're going to have an operating lease and a finance lease. The balance sheet will be similar to IFRS, but the income statement will be different. So in America, the conclusion was, if we're going to bring leases onto the balance sheet, because we're concerned about companies having inaccurate ratios, what we're going to do is still have two categories of leases. So this is why in America, we still have a finance lease and we still have an operating lease. Does that make sense? So the ISB's perspective is we want to keep things more simple. The Americans' perspective is because it's for the capital markets, it's important that we make sure we don't make things more misleading. EBITDA is a very important metric for a lot of companies. And net assets is also a very important metric as well, not as much as EBITDA. All right. So as we get on to the standard here, so basically we're saying, okay, because most of our analysts want leases to be on the balance sheet, what we need to do is to come up with a new approach to bring leases and to book them on as assets and liabilities. So what we're going to do in IFRS is remove the distinction between an operating lease and a finance lease. So this is going to cause some problems. If EBITDA was a key metric, your EBITDA is going to get screwed up. So when I've done work with telecom providers, they always focus on EBITDA, right? It's going to change. It's going to have a single model for all leases. It doesn't matter your industry. So all leases will be effectively a finance lease. There are going to be some exceptions for short-term leases. So if they're less than 12 months, we can basically not record the asset and liability. And the difference now is there's a lot more analysis between a lease and a service. That's the new thing. And that's actually quite a bit of work. So there's a lot more analysis between a lease and a service. There's some exemptions for short-term leases. So short-term leases will now also be, we can skip those, as well as low-value leases. Lesser accounting is pretty much the same. So let's think about this for a second. So if you buy electricity, would that be a lease? If you buy electricity? No?
No.
Why? You're confident. You sure? Because usually when people are confident, they're usually wrong, right? You say no? Never?
Not never.
Okay, but why do you say when you buy electricity it's not a lease?
As a consumer, when we are buying the electricity, it's not a lease. But if we are a distribution company and buying it,
No, this is a consumer. You have a factory.
oh, yeah.
So if you have a factory and you buy electricity, is that a lease?
You're buying it as an outright purchase.
Well, again, here's where it gets messy. The actual power obviously is not a lease, but what does it take to buy that power? So when I did work, when I did work, you have a factory, you have a power plant, you have a grid. So they put power onto the grid, right? Now, what if your factory's in a remote location and they run a wire that's just for you? And then you have a substation that is only for you. So what could happen is that when you analyze your contracts, you could find that actually there's a concept of what we call it an embedded lease, where when you have a service contract, a part of that contract could have a leasing component. Because if I have a wire that is just for you and a substation that is just for you, then we might have to apply the leasing standard. Do you follow me? So it's not as obvious, right? So the biggest challenge I find in IFRS 16 is what we need to do is go through and analyze our contracts to say, do they have a leasing component? And if you work on an IFRS 16 convergent project, the biggest aspect or the biggest headache is to go through these contracts and say, does the contract have a leasing component? And to do that, we have to obviously go through the material next, which we're going to go through, but that's the biggest headache. So don't just assume no. Does that make sense? So to have a lease, let's go through the definition. So a lease, basically, okay, we spoke about this already. The pattern of expense, under IFRS 16 it will be higher because an operating lease is straight line, as we mentioned already. Under IFRS 16, depreciation is constant, but interest goes down over time, right? On an operating lease. When you add the two up, you're going to find that your expense over time goes down. So again, this is what the Americans did not accept. So in U.S. GAAP, under the U.S. standard 642, under the U.S. standard, basically we still have an operating lease to make the expense constant. So the depreciation is a balancing figure in U.S. GAAP to have it constant. You have your interest, and depreciation is a balancing figure. In IFRS, we don't have that option. So in IFRS, it's going to recharacterize the income statement. And I guess the question is, which one is better? The Americans is probably more complicated, right? But it probably gives better information, wouldn't you say? It's perspective. The IFRS one is easier. But are we making things too easy to where it becomes more misleading? Again, this is a new standard from this year, so we're not used to this yet, right? That's one of the challenges here. The other thing to bear in mind is when it comes to intellectual property, you don't have to apply the standard. So if you have television rights, if you have any IP, intellectual property, that's under a long-term contract, you're not required to apply IFRS 16. So you only must apply IFRS 16 if it's a tangible asset. So if it's intangible, most companies that I've worked with choose not to apply it. So that's software, advertising, TV rights, if you buy different IP, that kind of stuff. So let's go through what a lease is. The definition seems easy, but again, the devil's in the details, right? So a lease is a contract to control an identified asset for consideration. So the key thing to remember here is a contract can have a leasing bit and a non-leasing bit. All right? So the biggest challenge here is what I call an embedded lease. An embedded lease is a contract that has a leasing component and a non-leasing component. That's what's challenging. So we're not looking at the entire contract. We're looking at part of contracts. We have to break it down. So contracts could be under IFRS 15 and IFRS 16. We have to split them. That's the hard part here. So when we talk about a contract, that's easy. That's not really challenging. Obviously, two parties sign a document, that's your contract. Where it gets more issues and more messy is in the concept of control, the right to control. So we have an identified asset and we have consideration. So an identified asset, and this is where it gets more messy. When we talk about an identified asset, it doesn't have to be explicitly mentioned in the contract. So an identified asset could simply be from a practical point of view. So we have to look at the ability of substitution. So it doesn't have to be explicit. That's easy, right? The contract has a serial number. That's easy. The more difficult ones are implicit. We look at things as the concept of the substantive right to substitute. How easy is it for the supplier to exchange that asset for another asset? That's one of the key aspects here. So if the supplier practically can exchange it, then we have an identified asset. Now, remember, there are three criteria. Criteria one is an identified asset. Just because you have an identified asset doesn't mean it's a lease. There's also the control aspect, which we'll get onto in a second. So when you do your assessment of whether we have a lease or not, if there is no identified asset, there is no lease, full stop. If there is an identified asset, there may be a lease. So we spoke about the power company, right? I didn't say it was a lease. I said it potentially could be a lease. We have an identified asset, a wire and a substation. So we need to look at the ability to substitute. Are assets available? Is it practical? And there's the economic benefit to the supplier.